Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is long verticals and diagonals. And it's been a pretty rough week for the S&P 500. But I got a question for you. Do you sometimes think that a market sell-off is a time for the bulls to be bold? That's what we're going to be talking about today. We're going to be adding a new position to our example paper money portfolio that's a little bit more leveraged, pursuing a higher reward, but also at a higher risk. We'll talk about the pros and cons of that in just a moment. Before we do any of that, first of all, I want to say hello to everybody that's joining out there on YouTube. Great to see Kevin and David, Will, Ted, Alfred, Robert, Bush8531, JB52, Cody, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to our discussions here. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. But be aware that you're invited to join us in the live discussion. This is a Thursday webcast series, and we kick this one off promptly at 11 Eastern. If you'd like to join the live stream, we'd love to have you here. I also want to let you know that my very good friend Connie Hill is going to be hanging out in the chats with us. She's going to be addressing any questions that I can't get to during the flow of the presentation, as long as they're not too far off topic there. Connie is there to pick up my slack, and we all know Connie is a fabulous presenter herself, brings a lot of knowledge and experience to this, so thanks for having my back, Connie. Connie and I would also like to issue an invitation to everybody watching, whether you're watching on the live stream or on the archive. If you have an X account, and meaning an account on the platform now called X, you should be following all of your favorite presenters here at Schwab. So you can follow Connie there at Connie Hill CS. You can follow me there at Cameron May CS. But that's really the very best place to connect with your favorite presenters in between these live streams. All right, you can find Connie. Anyway, sorry, I got a little bit distracted. I sometimes you'll see me multitask. I look at chats and I try to talk at the same time. It's not a good plan. In any case, let's dive into this. First thing that we always need to do before we get to the meat of the discussion, we need to pause to consider the risks associated with investing and trading. Certainly applies to options. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks and involves risks, including the loss of principal. And any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for the day. So in this webcast series, we plan and place example long vertical spreads and diagonal spreads, and we manage those over time. So there are some existing positions we need to go take a look at, see if they need some attention. And I think there's at least one that does need some attention today. Then we're going to take a look at the markets. Markets have had a rough week. What might that mean for, let's say, bullish traders? We're going to be looking at things through a bullish lens today. Can a market sell-off sometimes be an opportunity for boldness on the case in the case of market bulls? So today we are going to be taking a little bit higher reward potential trade. Also carries a lower probability of success, so a bit of a trade-off there. But before we're done, we're going to be planning and placing that example trade on the Thinkorswim desktop trading software platform. So Janelle says you're learning so much. Excellent. Now you're entering trades in paper money. That's fantastic. Well, let's go right to Thinkorswim and let's look at our existing positions. So we have 4 current positions. We also have 2 that were closed recently that I want to revisit. So we're going to do this fairly quickly. But on Amazon, we have a long call vertical. Bought the 220s, sold the 225s. We prefer for the stock to be above our spread here, or in other words, above 225. It's not above 225. This one's misbehaving. We're down a bit on this one. Actually, we're down fairly substantially on this one. If we go to the chart, you can see what's been happening here. We took our position when Amazon appeared to be in a nice upward trend, possibly bouncing off a support level, and since then, not cooperative with a bullish position. So here, these 2 horizontal blue dashed lines represent our position. There's just a representative of our 220 long call. This one represents our 225 short call. We'd like to be up here in the green box. We've fallen down into the red box. So we're down in max theoretical loss territory. If we stay here as we move toward expiration, losses could continue to mount. We've lost about half of what we could at this point. So for some traders, a trader in this position, they may have a few choices, right? They might decide to just hang on, do nothing. If this rallies, if we were to get back up above 225 before the 21st of March, and there seems like there could be time to get that done, maybe this just reverses itself and we're back in good position for a maximum theoretical gain. If we continue to sell off, though, and look at this strong sell-off we've had, maybe a bit of this, could this possibly be what some might call a dead cat bounce? A stock that falls really hard and then bounces. Maybe it's not really an indication of a pending reversal, but just a little bit of maybe a little bit of bargain shopping on the case of a handful of shareholders, relatively speaking. Yeah, if this continues downward, we could see losses mount on losses. So maybe in that case, the trader decides to get out of the whole thing. Now, there are some other things that we could do. We could consider legging out of the position, getting out of one side or the other of the trade. What I think we're going to do today is just stem the bleeding on some of it. We have 11 contracts. I think for today, we're going to close out 5 of those contracts. So we're going to be realizing loss on 5, leaving the other 6. Could they recover and make up for those losses on the 5? It's possible. But at least we only have 6 that could continue to add to the losses. So we got into this trade for about $3.40 net, bought the 220s for $13.45, sold the 225s for $10.05, so $3.40. And we were hoping to see that rise to a $5 value. Instead, it has fallen. The net between the two is now down below $2. So we've fallen from $3.40 down to below $2. And so we're sitting on about a $2,000 loss. And we're probably going to take, about a $900 hit, realized loss as we exit this. We'll see. But in any case, I'm going to right-click on Amazon, create a closing order, and let's sell out of that vertical. And this is going to, by default, bring up an order to get out of the entire thing. Well, I don't want to get out of the entire thing. Let's get out of 5. Looks like we're trading between 159 and 163. Remember, we paid $3.40 to get into this, so we're only selling out about half that value, even a little bit less than that. I'm actually going to dial this down and say that we're willing to, let's say we're willing to settle for maybe, do you think we can get $1.60? Probably not at this point. Maybe. Markets are on a contract that's gone either in the money or out of the money to a good extent. We can tend to see a widening of the spread between the bid price and the ask price, and that can cause faster fluctuations here between the natural and the mid. In any case, I'm going to submit an order. Let's see if we can get out for $1.60 credit. Looks like it's even above that at this point, but that can increase the likelihood of a fill. It's not a guarantee of a fill. Let's click confirm and send. The max profit, max loss, this where if we were opening a position, we're actually closing these 5 contracts, so we don't worry about that. But we are selling out of 5 of these verticals, the 220, 225 calls, trying to get $1.60. There is a commission here, so that chips into the net credit received. But let's send this order off, see if we can get a fill. Yep, sold for $1.66. That's almost exactly half for how much we paid to get into those 5 verticals. So we have stopped the bleeding on those 5. So you can see on the remaining portion of the position, down about another $1,000. So from here, what are we hoping for? Well, hopefully this bounce continues. We want to get back up here. But let's go on to our next position. Next position is actually being far more cooperative. So we have GILD. This is a long call diagonal spread where we bought some 2027 $95 calls. We have a very bullish bias on that. But we sold against that position some 21st of March 2025 105 calls. With this trade, we have a preference for the stock to go up, helping out our long calls, but to stay below that short strike of 105. So Well, it has gone up, but it's actually blasted beyond that 105. So looking at that, here's what that looks like. We own the long call down here at the 95 level, entered the trade right there, sold a 105 up here, and we might have thought at the time, oh, is it going to make it all the way up there? Well, a good earnings announcement actually spurred the stock up, and now it's gone beyond that. So the trade is actually doing very well, but the 105 is now applying drag to the performance of our long call. Now, in paper money, we have a bit of a luxury here. There's not a risk of early assignment. It doesn't happen in paper money. It can certainly happen in real life. But this 105 call is now in the money about $7. And the further a contract goes in the money, and especially the closer it gets to expiration, the higher the risk of early assignment, meaning that somebody could buy shares from us at that 105 level. With this one, I'm just going to actually let this one continue to work. We'll see if it pulls back a bit. Maybe it'll give us an opportunity to exit this 105 short call at a little bit lower price. But for right now, trade is doing fine. The trader here might just be satisfied. Hey, we're up $2,200. For the time being, that short strike is probably putting enough drag on the long that they're kind of offsetting each other largely. But I'm going to let this one work. See if we can maybe get out of these shorts a little bit lower level, or maybe a little closer to expiration. But that is a risk in real life. Just remember that contract, those short contracts could get assigned. They're just not going to in paper money. So with Microsoft, what's going on with Microsoft? Another long call vertical spread. Bought the 395s, sold the 400. We like to be above 400 is optimal on this trade. Look where we are right now. We're about 399-ish, 398, 399. So we need this one to get up a little bit. That might not sound like it's doing so badly, but if you look over here at our profit or loss, we're actually losing money right now. Why is it doing so poorly? Well, it's because when we took this position, this was a high probability trade. When we first got into it, we entered it here when there appeared to be a pretty good support right at about that 408 level, broke down through that support recently. Here are our two strikes down here, and we're now trading right between those strikes. We actually came down and teased down at the max loss territory, but maybe starting to rise again. With this one, I think we're going to let this one work, but just remember, we have we do have a short option involved here. In this case, assignment of the short is actually the ultimate objective of many traders with the long vertical spread. Assignment of the short means that we could exercise the long, and that would realize the maximum gain of the trade. But if we wind up between the two strikes, if we just strike where we are right now and we hit expiration, our long would automatically be exercised on our behalf, and we may wind up buying shares that we never intended to buy. And how many contracts do we have here? 10 contracts. And if we were exercised at 395, well, that's $39,500 for one contract. Multiply that by 10, $395,000 stock purchase. I want to keep an eye on that one, right? Okay, so Microsoft doing okay. It's not behaving like we would hope, but it's still pretty close to where we need it to be at expiration. We're going to give that a little bit more time to work. Let's go to our UNH position. Now, this is one that we committed to right when we kicked off this series at the start of the year. The premise of my discussion was, what might happen if we commit to a single trade for an entire year? So we bought a long-term call option with the intention of selling shorter-term options against that, creating diagonal spreads along the way. So we bought the 520 call, still a year and a half, 2 years on that, actually 2 years on that contract pretty much, but it is not treating us well. Bought it for $102. It's only worth about $63 right now. It looks like this trade is just getting hammered. But actually, Against that long call, just as we had originally planned, we've been selling short calls. This one's a little bit more complicated. Follow along with me. With UNH, we bought our long call right back here. And initially sold a 560 short call. This red dash, this sort of pink dashed line represents the period of time that we were in that 560 short call. So we initiated the trade here on the 8th of January, and we wrapped it up right there on the 13th of February. We wound up closing out that short call for an $860 profit. And when we did that, closed that out, we sold a second short call at the 550 level. So if you can see this in pink, that trade we were only in for a week. Sold that one, closed it out a week later for a $672 profit. And at that time, we initiated a third short position, sold the 540 short call. That was here on February 20th. Let's see how that one's doing. Alexis says, thank you for discussing UNH. Yeah, I remember you had asked me yesterday about it, Alexis, and didn't have time for it in that webcast. Plus, it wasn't traded in that webcast series, but we'll follow up on it in this one. So our 540 short call, we sold that last week for $4.50. That's only worth 74 cents right now. So we could close that out right now for basically pennies on the dollar. And I think that's what we're going to do again. Let's look at our chart one more time. So here's what's happened on UNH. Anybody know what's going on here, why UNH is having such a sharp sell-off? And you might say, Cameron, why don't we just sell that long call? Because I committed to it. The premise of that discussion on January 9th was to keep this thing and just roll it throughout the year, see what happens. Because some people do this. And it can work, but if we have a persistently bearish market in which we maintain a persistently bullish position, that can still be tough. All right. But in any case, let's maybe consider, okay. There you go, Vic. Yeah, the Department of Justice investigation. There was a Wall Street Journal article recently that says the DOJ has opened an investigation. Now, I don't know. I'm not an expert in this. I don't know exactly what happened with United Health Group, but I do know that obviously they're contesting the Department of, or actually just the article's claims about what's happening with the Department of Justice. Lots of gray area stuff going on there. But there was a pretty strong sell-off, followed almost immediately by a sharp recovery. I found it was interesting, maybe for a technician it might be interesting, where we bottomed out a few days ago. If we look at this on a longer term chart, we go to like a 10-year chart, we just touched those 5-year lows. We'll call it closer to 4-year lows. So could that be enough to catch the falling knife here and send us bouncing back higher again? Well, I'm sticking with this position for better or for worse, so let's hope that's what happened. But for now, let's manage this short call. Into it for 540, maybe we can get out of it for 75 cents or so. So that could add to, we have realized gains in excess of, about $1,500 on the first two short options that we did. This one might be another $375 gain, maybe. At the same time, though, let's maybe add another short call here. So we're going to close up this one. I'm just going to make the assumption that we're out. So let's edit the properties of my color scheme here. This is sort of my way of saying we're done. Actually, that's too light. Let's edit that again. That one. There we go. Anyway, so that's going to wrap that one up. Make that that line the same color. And even, what is today? Right there. I'm going to have to shorten this one up to indicate that we wrapped it up today. Little tiny short trade that made us another $3. I say made as though it's in hindsight. we still have to successfully exit the option, and that's not always a guarantee. But at the same time, I wonder how much we could get if we were to sell like a 530 call. We could carry that out to March 21st, maybe even look out to April. Let's go have a look. If we go to 520, that would turn this diagonal into a calendar. 21st of March. If we did the 520 calls, that's about $2. How about we look at rolling those out maybe to April? 520 or 530. Okay, an April 530 call. I think that's what we're going to do. That looks like that's trading between $5.10 and $5.50. So if we're buying out of our current short option for, let's say, 75 cents, and then let's say we're able to get into the next one for 525-ish, that might be for about a 450 credit. So how about we do that? Let's go to our monitor tab. I'm going to right click on this 540 call. Let's create a rolling order, which says it's a calendar, but which involves a long and a short call option in this case. But really all this is doing is buying back the one that we're in right now, the 540. And then we're going to sell, let's move this out to April, the 530. Yeah, it looks like maybe a 458 credit. Let's say that we're willing to accept a 450 credit on that rolling order. So this will realize the gain on the 540 if we're able to get this order filled. The pro of doing this is we're entering into a new credit transaction that if it expires worthless, or if we can buy out at a lower price, maybe we can add some additional profit to the short side of this trade trade series. But we also have to wait around potentially longer because we're moving this out to April, and we're lowering that strike so it can go in the money more easily, getting above 530 versus 540. Alexis says, why not sell the 500 and turn it into a short vertical of sorts, right, Alexis? Could we sell below our long strike? As illogical as that might sound to some people, yeah, actually, we could. And that creates a sort of a hybrid trade. It's kind of it's kind of a vertical spread, but there's still a difference between the expirations, not truly a vertical. It's kind of a diagonal with a vertical embedded kind of a weirdness. And I'm going to try to keep it as simple as possible, Alexis, but that's a good question. But let's click it. Let's click confirm and send here. So we're going to look to get out of the 540 into a 530, net credit of 450 minus our commission of $1.30. Let's see if we can do it. Let's go to our working orders. Yeah, we're still asking for a credit that's under the current market value, or the current mark. So I think we have a pretty good chance of getting that accomplished. Let's let that work for a little while. But while that's working, let's have a look at two other trades that we have closed out of, one of which we closed last week. Let me show you what happened last week. I'm going to go to our account statement here. And by the way, here's the chain of events with UNH, if you want to see that. So here's the 520 call that we bought originally for 101.95, sold the 560 for 9.55 and closed it for 95 cents. Sold a 550 for 9.65 and closed it for 2.93. And then sold the 540 for which we're right now trying to close. So if you wanted to see that series, there it is. But last week, we decided to get out of AVGO. So we were in a long call spread for a 335 debit. And we closed that out for a 307 credit. So my math says if we pay 335 for something and then sell it for 307, that's a 28-cent loss, setting commissions aside, right? And on 11 contracts, $28 per contract. Let's do the math here. $28 per contract lost. times 11 contracts is that's a $308 loss. Ouch. Tough, right? Well, is sometimes taking a smaller loss a good exit? Let's see what happened with AVGO. Oh, look, we got that roll filled at 450. Okay, good. But let's go have a look at AVGO. We wrapped this up because, just to revisit history here, we were having our discussion right here. This was Thursday before expiration. We were in our max gain territory, and yet we decided to take a loss. All we had to do was let this go, and if we just got to expiration right where we were, we'd be in max gain territory. Could have been a highly profitable trade. The next day had different plans, though. This is one of those risks when we're pushing a trade right up to expiration. The stock can just do one unexpected thing. And in this case, if the trader turned their head away for a little while, stock plummets. This went right down to max loss territory. And on this trade, if we had, what do we pay? $335 to get in it? I believe that's right. If we go back here to our account statement, a $335 debit. That was $335 per contract times 11. $3,685 we could have lost had we just left that trade on. So to me, that's like could have lost 11 times more. Actually, it's even more than that. I'm just going to do this out of personal curiosity. What did we lose? 308? $3,685. Let me do some quick math here. 28 times 11. Yeah, we had a 308 loss. Okay, so 3685 is what the trader could have lost had they just held on for that one more day, which is 12 times as much money in one day. That's how sticky you can get right at expiration if a stock misbehaves and we don't do anything about it, or circumstances just allow that to happen anyway. So I would call that a nicely managed trade. There's one last trade, and that is our AMD position that we took last week. If we go back to our activity and positions, just last week we bought into a long put vertical on AMD, but you'll notice we don't own AMD anymore. Let's look at what happened on the charts. I told you I wasn't terribly optimistic about this trade last week because the markets had been so strong. Well, the week actually turned out to be right in the favor of a bearish trade, which is what we did. And AMD stock went down fairly sharply. Notice this trade was taken for the March 21st expiration. Here's the details of the trade. We go back to our account statement. Let's bring up AMD. So we bought into this put spread for $3.80. It was a $5 wide spread. So what we're hoping to see is for the stock, or for this trade, to go from $3.80 in value to $5 in value. But we had a trade, an exit trade in place. If we can even get close to $5, let's get out. Maybe that happens right away. Maybe it takes a while. Maybe it never happens. Well, in this case, within that very first week, we were able to close that position out. It closed out automatically at $4.80. So we made $1 on that trade, whereas the maximum we could have done, holding all the way to expiration, March 21st, was $1.20. So that's a nice little trade there. So that's it for our existing trades. Let's put a new position in the portfolio. But before we do that, I want to revisit the week that the S&P has had. It's been kind of a tough week. Look at all those red candles in a row. So at this time, what do you think is going on with the fear levels in the market? Do you think that there are investors out there who are asking themselves, is this the beginning of the end for the bulls for a while? Is this the start of a great sell-off? Maybe that's what happens. But I wanted to point something else out, technically, that might be interesting. Let's come up here to our Edit Studies flask. and I want to put on a simple moving average. Let's add that to our chart. And specifically, it's the 100 period moving average that's been kind of interesting throughout the last 12 months. Let me make this 5 out of 5 for width. Click OK, click Apply. So this 100 period moving average is a trend line that some traders might use as an indication of whether, pullbacks are truly indicative of a trend reversal, or if the trend line is persisting higher, maybe it's just a hiccup. Maybe it's just some selling off within a persistent bullish trend. And through that lens, this may be the case. Now, another potential application of a moving average is areas of price floors and price ceilings in an upward trending stock or index. That maybe that's a price floor. But if you look over the last 12 months, there have been a few occasions where we've gotten down to the neighborhood of that 100 period moving average. And then right after that, the S&P has had a nice run. Here we actually got down through it for a couple of days before it began its run. But here, that was a pretty good price floor, and off the S&P ran. Here, that was a pretty good price floor, and off the S&P ran. So what might be the lesson for would-be bullish traders who are using this as an indicator of the timing of entries? Well, maybe at times when fear is broadly heightened in the markets, that may be a time for a bull to be bold. Now, we don't know. We don't have any insight into exactly what the future holds. Could this be the start of a continued sell-off? It could be. Another thing that we might note here as we look at this touching those recent lows, getting down here around that 100 period moving average, look at the long tails on each of these daily candles. That's another thing that some traders might look to as an indication that an index or a stock is ready to start rising again. When we get these long tails at the bottom of a down move, might signal that we're starting to go up. But in any case, let's say that our trader, oh, I clicked on the wrong button. There we go. Let's say that our trader thinks, you know what, in my assessment, this looks very much like this event here. It looks very much like this event here. It looks very much like this event here. Maybe it's time to get bullish, and maybe it's time to be bold with getting bullish. Now, time will tell whether that's the right idea or not, but that's going to be our premise for today's trade. So let's go place a trade, and I'm going to do today's example trade on JP Morgan. So how was JP Morgan selected? Well, we've talked about this in the past, but some maybe pre-qualifying characteristics of a stock on which the trader is going to trade some options. They might be price per share. We might also consider the liquidity of the stock. Illiquid stocks tend to have illiquid options, which can lead to pricing issues, wide spreads between the bid and the ask. On the options chain, it can make it tough to trade. Ian says, would you wait for a hold as confirmation? For some, they might. Yeah, Ian. Now, whatever the trader's specific entry rules might be, that can vary from one trader to another, right? A hold is just where we wait for a stock that's falling to hit a low and then a close above the high of that low day. That's one potential reason to get into a trade. It's not the only one. For example, here we have an upward sloping moving average indicating possibly a continuing bullish trend on JP Morgan despite this strong sell-off. Now, what some other technical traders might note as potentially interesting is that starting here in the third week of December, JPM really went for a run. Little pauses here and there, but really ran up and up and up and up. Had a 50-point increase in about 2 months. That's about a 20% increase in about 2 months. And then relatively rapidly surrendered half of that. And for some, they consider that to be sort of normal behavior if they count themselves among those that use this thing called a Fibonacci. Now, some of you may not be terribly familiar with Fibonacci's. That's okay. What you want to make sure that you do if you're not subscribed to our YouTube channel, make sure that you go down, click on the subscribe button below the video right now, because YouTube is where we host our previous webcasts. You can also join our live streams here. But if you go to our YouTube channel, Trader Talks Schwab Coaching Webcasts, you can do a search right here on that channel homepage. And let's say you wanted to learn about Fibonacci's. We type in Fibonacci, and what do you know? Here are some webcasts. How to use the 5 Fibonacci tools on Thinkorswim, or Beginner's Guide to Using Fibonacci's to Trade Stocks, and some actually could use the same concepts for trading options. But in any case, yeah, make sure that you're subscribed to the channel there. But what I noted here is this strong run-up. We've given back half of that, come down here, and pretty close to, Ian, right? A bounce, a close above the high of the low day right there. Now, that 50% retracement on a fib also coincides with the high that preceded this low in December. So maybe there are a few bits of technical evidence inclining a trader toward bullishness. Now, again, I always have to say time will tell whether the stock continues to rise, because as you've seen, some of our trades, it seems like we have a good idea and the trade doesn't go as planned. But let's go place a new trade here. And let's say that our trader wants to be comparatively bold. How do they do that with, we're going to do a long call diagonal. We already have a couple in our paper money portfolio. Let's add another one. I'm going to put on a long call diagonal. And specifically, let's do it out here for April, because we already have contracts expiring in March. Let's do an April trade. Well, to be more aggressive with a long call vertical, here's what the trader might do. Let's go out here to 17th of April. More conservative, and this is how I'm going to define conservative, is a high probability of success. The higher probability vertical spreads can be constructed in the money. You can use potentially delta as a guide, but in the money vertical spreads tend to have a high probability of success. They have lower reward potential as a result. If we're willing to settle for a lower probability of success, just because maybe the trader thinks, forget the probabilities, I think the stock's about ready to make a nice run, maybe they go at the money or even out of the money. Today, what we're going to do, let's do an at the money trade with the stock trading around 262. What we're going to do is buy the 260 call and sell the 265. So on our chart, that's going to look like this. Let's clean up our chart. Let's see, do I want to delete the fib? I like having the logic of the trade here. I think I'm going to leave that on, but let's draw in a 260 from right here. 260 is going to be right there. Let's carry that out to April. And let's go up to 265. That's going to be right about, yeah, that's close enough. 264.91, close enough. I'm going to take that out to April. And those represent the two strikes that I'm going to use to build this trade. So for this trade, it's a bullish call spread, or a call vertical. We want to be up here as we move toward that April expiration. Where we do not want to be is down here. Let's make that one red. There we go. So if you note where we are right now, we're closer to max loss territory than we are close to max gain. We're sort of splitting the difference, but this I think you can see intuitively, we're taking a bit of a risk here. Well, with vertical spreads, when we take a larger risk, there is a mathematical sort of reward for doing that. It increases the reward potential of the trade. So let's go see what our trade details are. So 260, 265. If I change our spread from single to vertical, how much is that trading for? Between 255 and 285, right? Let's say that we're able to buy this for 270. If we pay 270, for a $5 wide spread, we're hoping that we can turn that into a $5 value. So if we buy something for $2.70 and ultimately it turns into $5, that's a $230 profit potential. That's nearly 100% reward potential in about a month and a half. Is that a lot of reward potential? Yes. Is it a lot of risk? Yeah, it's not actually even where it needs to be. We need the stock to go up a bit. So it's a way that a trader might be a little bit more bold, taking a lower probability of success in pursuit of a higher reward. If we were to go in the money, let's say we did like the 245 and the 250, still a $5 wide spread, looking to turn that trade into $5. Well, that might, let's say, cost us about, between $3.40 and $4. Let's say it costs us $3.70. If it costs us $3.70 to get into that trade, there's only $1.30 left. Turning $3.70 into $5 only leaves a $1.30 of reward, but the stock there would only need to get above 250. It's already well above 250 right now. That trade would have a higher probability of success, lower reward potential for being successful. So let's go down here. It's going to be a bolder trade. Let's click on the ask price to create that long call spread. And it looks like our price is already moving in the right direction. We might have to spend up, let's say we're willing to pay $280 for this now. So $280, if we're buying that for $280, that's the risk of the trade. $280 of risk. In this webcast series, we typically are willing to risk up to $4,000. So let's go $4,000, divide that by 280. And we can do 14 contracts. So Francisco says, what is a good delta as a guide? So there's no such thing as a good or a bad delta. I can say there is a high or a low delta. High delta means high probability of expiring in the money. When we have long contracts, that's what the trader is trying to do. So that means high probability of success. But there's a teeter-totter effect. High probability of success means lower reward for the potential success. Is that a good combination? Depends on the trader. If we go for a lower delta, there's a lower probability but a higher reward potential. Is that a good combination? That depends on the trader. So what the trader needs to do to answer that question for themselves is find the delta where they see the right balance between probability of success and the reward for actually being successful, the potential reward for being successful. All right, but there we go. Let's place this trade. Let's click confirm and send. Gonna buy, oh, wait a minute. I need to edit that trade. Gonna do 14 of these. There we go. Now let's click confirm and send, buying 14 of these verticals, the 260, 265 call vertical. Gonna try to get in for 280. That would give us a maximum profit. Yep, it's under our $4,000 limit. Pardon me, our maximum loss under our $4,000 limit. Maximum profit around $3,100 if we can get up above 265 and be there as we get toward expiration. There is a commission here to be considered, so we need to remember that, but I'm going to send that order off, and we are now in for 260. In for 260, that leaves 240 for potential profit. Okay, so guys, we're going to see how this goes, but yeah, a little bit more of a bold trade because we need that stock to get going. And actually, if we look at what's happening early, not going the right direction. Time will tell. We have 49 days to get up there. That's where we need to go. But that's going to do it for today's discussion. We have talked through, I spent a lot of time, and I was okay with that, going through our existing positions and through the two positions that we had previously closed to learn lessons from that and to talk about management techniques. Then we looked at the markets to talk about, is a market sell-off sometimes an opportunity for a bull to be more bold? And now we're in a more bold position. We'll see if that plan comes to fruition. We could make about $3,100. We could lose about $3,900. Depends on where the stock heads from here. among obviously a few other concerns with options. We know that. But in any case, thanks for giving me your time today, guys. We'll follow up on this in a future webcast. I hope that you'll join me then. I also want to make sure that you, if you haven't done it already, one more quick reminder, make sure that you have subscribed to our YouTube channel. You can pop down below the video stream right now. Click on subscribe. If you're watching on the archive, you can still click on subscribe. Doesn't cost anything. It only takes a second. But our Trader Talks channel is where we host those playlists of previous webcasts, and you can join the live streams right there. Also, make sure that you're following Connie and me on X. You can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. Very best place to connect with your favorite presenters in between the live streams. And that also doesn't cost anything. If you have that X account, you can just go give us a follow. And thank you for everyone who's already clicked the like button. Looks like we have about 200 people watching. About 70 people have already clicked the like button. Thanks for doing that. Always sounds like applause to your presenters, and it gives the presenters webcast a boost in the YouTube algorithm. It just helps more people learn this stuff. So thanks everybody for doing that. Go enjoy the rest of our educational offerings through the rest of the day. I'll see you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.